Welcome to another episode of the F Word and Friends, and our friend today is Roné Swanepoel from Morningstar Investment Management, and she's also a CFA. That's very difficult. I know Francia won't understand, but chartered financial analyst. So she's very clever with investments. It's like you go very deep into investments.
That is.
So with that, did you ever learn about the rule of 72? What is that?
If you think about compound interest, there's this thing called rule of 72. So I always think of your toolbox when you think about investments. What is like just quick and easy rules you can use. So the rule of 72 is you take 72 and you divide the annual return, annualized return you get out of your investment. So let's say you're in a balanced fund. It's given you 10%. So you'll take 72 divided by 10, that's 7.2. So that's the amount of years it'll take your money to double. So your money will double in about 7 years if you earn 10% annualized and you use the rule of 72. So just a quick one to know, when's my money going to double?
So aim for high returns.
Yes.
Basically.
That
So how
would be
do we
the
do that? Yeah.
I think it's always very difficult to try and aim for higher returns. You want to earn consistent returns. I think consistency is probably one of your underrated elements within investments. Consistency. I always think about first and second quartile returns, third and fourth quartile fees. That's going to give you consistency.
But I had a client, young client, normally we say older clients are more risk averse, they only want to put money in the bank, but this client was like 30 years old and she came from a poor background. She doesn't want to take any risk with her money. She saves like 62% of her salary and she just wants to invest and want to see it grow. But she invests in money market. And let's say that's the average of 6 or 7%. And I just tell her, to double your money, we have to aim for higher growth. So we have to have exposure to shares. Will it definitely outperform it? We know in short term, definitely you can't guarantee anything. But the probability of higher returns, we always say low risk, low reward.
Yeah.
Higher risk, higher potential rewards. So you have to, then you know, okay, to get the highest possible return, to double my money quicker, that's what we all want to do, is you have to take a bit more risk.
And if you've got time on your side, you can take a little bit more risk. If you're 30 years old and you've got how many years left until retirement and you're sitting in cash, you're missing out on compound interest. You're missing out on that compounding of growth in a little bit more high risk. You don't have to go full equities. You can blend it with bonds. You can have a little bit of cash, but don't sit in cash, especially not now, when if you think about an interest rate cycle, there'd be probably in the interest rate cycle where the next step might be a cut in interest rates. So that means cash is, over the longer term, might come down, the cash returns, where now you're earning equity-like returns on bonds. You've got global equity that's actually undervalued. You've got SA equity for the first time. I think no one would have believed that SA equity would have done well. It's a very good opportunity.
But I think it's important to remember that there is place for cash in an investment portfolio. I mean, looking at financial planning, liquidity needs of a client. There's always a liquidity need. There's short-term needs. There's emergency fund needs. So there's definitely a point to having cash, but that's more emergency or let's say more a saving instead of the investing part. The investing would be more towards a little bit more risky assets like equities. But nothing wrong with cash, and obviously, like you said, times are changing where interest rates will definitely come off. But that does not mean that you should move out of cash. If it's part of your picture and it's part of your financial plan, stick to it. And exactly the same with equities as well. Whatever happens, just stick to the plan.
Have a
That's
plan.
important. Have a plan. Start with having a plan first. Yeah, absolutely. Absolutely.
So what's your opinion of rule of 72? I know that's your golf score normally, but
At last I got a little bit of a compliment from this man.
that was a sarcastic.
That was very sarcastic.
Now, I think the rule of 72, if I'm not mistaken, it counts the same for inflation as well. So if you've got 72 divided by your inflation number, let's say 6%, where sort of inflation is hovering most of the time for a lot of people, we're looking at 12 years until your money has halved in purchasing value. And I think that's also the very important thing to understand is we've got both sides. We've got the compound interest, which is great. So if you're earning 12%, it's 6 years until you've doubled your money. But now you've got a person who's in a money market fund over a 12-year period, and now all of a sudden her money is actually halved in purchasing value. So it's very important to understand both sides. But what I want to ask Roné is, what do you see, what mistakes do people make that hinder this compound growth from actually happening in their portfolio?
You start a little bit too late.
Okay.
The earlier you start to save and invest, the more compounding counts in your favor. The later you start, you can start later with a higher amount, but you're still going to miss out on that early years of compounding. So I always think, if you think about compound interest, it works, and compounding, it works the best the earlier you start saving. That's when that true, I think about compounding, and then I have this picture in my mind of like the snowball effect. It's like that small, yes, that exponential, like it starts small and then all of a sudden you see this increase in value. And that is really the power of compounding. I think it's something that a lot of people in investments don't think about enough, is compounding.
But it's so difficult to see when you're young, because when the values are quite small. Because if you have 10,000 Rand and you get 10% growth, you've got an extra 1,000 Rand. Great. But if you have $1 million, it's 100,000 Rand. And if you have 10 million Rand, you actually get that $1 million Rand for doing nothing. So that's a magic. You see it in the end. But I know, like Warren Buffett always, if he retired at 65, no one would knew. He would, like a billionaire, $1 or $2 billion, shame. But
what a tough life.
But on 85, that's when the magic
when he made most of his money, and that was the true compounding, sticking to good businesses that are undervalued and sticking it out over the long term and getting that compounding effect.
So thank you, Roné, for your CFA knowledge. We now know about the rule of 72, and thank you for that, to think about it both ways, about the interest and on the expense side with the inflation.
And maybe one example that I think is sometimes when you think about compounding, and I'll ask you this question because I always love asking it because it's good when you think about compounding. Would you rather for 30 days have 1,000 Rand a day that I give you for 30 days, so every single day you get your 1,000 Rand, or would you take 1 Rand that doubles every day for the next 30 days?
But it feels so nice to say the 1,000 Rand because that's what people like. That you know you're going to get 1,000 Rand.
And
the 1 Rand
no one wants a 1 Rand that doubles. You just think about 1 Rand. If you do it, and you can go check on an Excel spreadsheet, and I've done this exercise many times. After 30 days, if you took the 1 Rand that doubles every day, you'd have 500 million, and you'd have 30,000 if you took the 1,000 Rand. So it just shows you.
I did that exercise. It's 500 million a day.
Over 30 days.
Yeah, over 30 days. So I thought it was compound. It's like actually on a day. So it's insane.
It's actually that story. Have you heard the story about the Chinese chessboard maker before? It's exactly that. So there was this emperor in China, and he wanted a chessboard. So this chessboard maker made him a board, a very fancy board. And he said, well, don't pay me in money, pay me in rice. And for each day, you must give me 1 grain of rice and then double that for the next day. There's 64 blocks on a chessboard. By day 32, there was not enough rice left in China to pay him. Long story short, the emperor got mad, he was duped, and then he killed the Chinese chessboard maker. But it's exactly the same concept. If you go and have a look at it, the numbers are astronomical. And but you need to have a little bit of foresight when it comes to these type of things. When you're investing, even if it's a little bit, in the future, you'll be glad that you did it.
Yeah, and that's a magic about compound growth. And just, this might be a bit technical, but that's also with retirement annuities, and what a lot of people miss is that compound that you get in retirement annuities or living annuities or tax-free savings is tax-free compounding. So that makes a big difference. Let's say you get a 10% return on a normal investment minus 30% tax, so that's only 7%. So if you get that compound on the tax-free growth, that gets you closer to the rice board numbers. So it's amazing about that. Thank you, Roné. Thank you, guys. And if you like the video, please like and subscribe.